All right, let's talk about Sleep Number, as this is one of my highlighted stocks for the earnings reports of the week. We're going to be looking at this. They just reported this afternoon after market close. They're down 2.7% after being up 3.6% in the normal trading session. So downward move. So we're going to take a look at why exactly that might be. If you recall, I did anticipate a beat on both top and bottom lines for this company, really just due to the increased demand, in my opinion, for what we see as far as mattresses are concerned. They were expected to decline quite a bit, 25%, or I think it was closer to 30%. They were expected to decline year over year, and I didn't quite see that happening. So I personally anticipated definitely not to see that, and I definitely to see a beat on that aspect. Because of the fact, well, you think about it, obviously they're heavily dependent on retail for sure. They are. So that is going to be an impact on the matter. But in current times, pandemic times and lockdown times, people are really focused, and they're focused on sleep and really health, personal care. They have a lot more time to sleep, so they want a better mattress. And the Sleep Number is nice, especially if you're sleeping with your partner, significant other, and you realize, well, both of you don't like the same mattress. Sleep Number got you covered. So that's why I anticipated some growth in terms of that. So let's take a look here as Sleep Number. What a shocker. I told you. Gap 2 EPS of negative 45 cents, beats by 16 cents. Not beautiful, but it is a beat. And revenue of $284 million, which is down 20% year over year, beat by $33.89 million. Now, it was a beat in terms of revenue. 20% downward movement obviously isn't beautiful, but when you talk about the fact that during this quarter, majority of their retail segment was completely shut down as far as physical retail is concerned, and physical retail is dominant in the mattress industry, all things considered, mostly for the fact that people like to try out a mattress before they purchase it. They, really do. If it's something you're going to be sleeping on for 5 to 10 years, you probably want to know what it's like before you just buy it randomly online. So therefore, having retail shut down is rough for them. So it's a benefit for them that I think they may have gained some customers during this. So Sleep Number is down after beats. Gross profit fell to 57.2% of sales during the quarter versus 61% a year ago, reflecting a product mix change and sales deleveraging as a result of the pandemic. Looking ahead, the company expects to meet its liquidity needs from operating cash flows and its existing credit facility, while funding growth initiatives and other long-term opportunities. But no full-year guidance was issued by the company, and there is the issue. That's why the stock's down. They refused to give guidance for the full year. Obviously, that leaves investors questioning, well, why aren't they confident about this? Aren't they confident about recovery? And if a company's not giving guidance, that's the one of the three aspects that investors really look at. So looking from that too, saying that they can meet liquidity needs from operating cash flows and existing credit facility is good. That means they're not going to need to take out extra cash and take on extra debt really to fund what they're doing, which is a good sign, especially from a non-profitable company. And it's one you look at, you wonder why I highlighted it. It's an interesting one to look at when you think about, we talk about the market cap on this company actually of only around $1.48 billion, right around $1.5 billion. When annualized revenue on this company is not a bad number, right? We're talking about annualized revenue somewhere right around, well, $1.4 billion, you know what I mean? It's really close to that, all things considered. So, I mean, annualized revenue is pretty much above their market cap. The PE ratio is definitely going to change quite a bit because of, unprofitability this quarter and likely next quarter as well. But as far as valuation on the company, it's trading very cheap compared to where it's actually positioned right now. So it is a stock I'm interested in. And you may say, obviously, well, there's a lot of room I could have picked this up on, right? We're talking about back in the $15 range earlier this year. Definitely messed up there. The stock's near its highs. $61 is the all-time high, 52-week high, I should say, for this company, which is the all-time high. But looking out, there were some good levels to pick the stock up at. We're talking in the $15 range earlier this year. Definitely, I should have, when I was talking about it, should have picked it up. Big mistake by me, and there's room for the stock to run down, obviously, as they probably won't have a great quarter next quarter either. But still, that market cap's trading cheap. It's trading cheap. Looking at this press release that they sent out, we see high single-digit demand growth for the last 2 months of the quarter after being down 48% in April. Son of a gun, 48%. A little knuckle crack, don't mind me. Can't go wrong with a little crack. Don't take that out of context. More than 95% of our retail stores are now open, compared to 53% on average during the second quarter. So again, 53% of their retail stores were not open. So to see only a 20% dip in revenue, pretty impressive. When we talk about 50% of the stores being closed, pretty nice to see only a 20% dip. Cash and liquidity available in our credit facility was $295 million at the end of the second quarter, $129 million increase versus the same period last year. So they increased their cash and liquidity statement. We'll look at that. So net sales down, as we saw. Operating expenses reduction of $35 million, or 17%, reflects immediate actions taken to reduce expenses, and diluted loss per share of 45 cents versus a net income per share last year of 14 cents. So again, not profitable, but they were profitable last year, so just a rough quarter, and you can't expect much from them. They generated $87 million in net cash from operating activities for the first 6 months of 2020, up 24% versus last year. It is good to see that. Invested $22 million in capital expenditures compared to $34 million from the prior year period. They recently acquired a patent portfolio from Gentherm to further strengthen the competitive position related to cooling and heating beds and bedding. Pretty nice. Return on invested capital of 17.2%. Nice. Outlook, obviously, no outlook is interesting. I do want to look, obviously, at the balance sheet, and then we can wrap this video up and see if the stock's worth taking a look at. Total current assets on this company of $141 million versus 6 months ago, $160 million. So a little bit of a decline in that aspect for sure. Total assets in general of $768 million versus $806 million 6 months ago. So definitely some expenditures were taken, and they've decreased in terms of the assets category. Most of that, you really see a difference here, is going to be on other assets, as well as accounts receivable has decreased. So liabilities, for current liabilities, you do see $562 million versus $594 million of 6 months ago. So definitely they're being outweighed from the total current and assets and liabilities category. They're getting outweighed by liabilities by a large margin. Now, current total liabilities in general of $931 million versus $965 million 6 months ago, so they decreased that as well. But overall, not a good sign there when you see shareholder deficit of $163 million. You don't like to see shareholder deficit for sure. Now, I think, in my opinion, it is for that reason I likely will be avoiding this company for now. I would have liked it back at the $15 range, that's for sure. I think under 30, I really, really like this company, but I don't think that's fair to ask for. Just for the sake of the balance sheet, I don't like it as much, but the valuation is pretty cheap on this company. But just because of the balance sheet, I'm not 100% into this company. I like to see a shareholder equity, in my opinion. Deficit isn't beautiful, especially in times of pandemic. I don't like to see that because there's a chance they may need to raise more capital, and I don't like seeing that. So, especially that current liabilities is not looking good. Current liabilities definitely is the one that scares me a little bit more. I don't want them to have to raise capital, but if they got to do what they got to do, I'll be looking to get the stock cheaper, but I love the valuation right now. I don't like the company right now as far as the balance sheet's concerned, though. So definitely going to be avoiding this one for now, but keep an eye on this stock. Could be very good.